So I've been working with expats now for well over a decade, and the biggest tool in the toolbox when working with expats and international tax planning is the Foreign Earned Income Exclusion. I've talked about the Foreign Earned Income Exclusion on several videos, which you can find links to here and here. But basically, the idea is it allows you to exclude up to, in 2025 at least, $130,000 of your earned income. But a nuance to that often gets overlooked is for capital-intensive businesses. So today we're going to talk about a specific client example in the e-commerce space, how we worked through the nuances of this capital-intensive business aspect of the Foreign Earned Income Exclusion, and how we got to a good answer for them and avoided a big limitation on the Foreign Earned Income Exclusion that otherwise would have existed. If this is your first time watching, my name's Alex McGowan. I'm the owner of McGowan Tax, where we help individuals and small businesses save money and solve international tax problems. So a capital-intensive business, that's going to apply to anybody that's selling a product as opposed to just a service. So let's say you have an e-commerce business and you're purchasing a product and selling it online through Amazon or Shopify or something like that. Or you're just making a product. Maybe you make shoes and you sell it in the US, or you do pottery or art or something like that. That's a product that you're selling, you have inventory, and so that's a capital intensive business. So with this specific client, he was living in Spain and he came to me with questions about the Foreign Earned Income Exclusion, and he met all the basic tests, right? So if you're looking online at what the Foreign Earned Income Exclusion is, physical presence test, the bona fide residence test, basically it just means you're living outside the US and you're not spending too much time in the US. That's one part of it. But the other part of it has to be foreign income and it has to be earned income. So those two pieces are what we're going to talk about here in this video. Let's talk about the earned income aspect of it, which actually is the complicated part. So the whole point of that and the whole point of the exclusion is that the IRS wants to exclude income from the performance of services. So things like wages are from the performance of services, and that's why they always apply to the Foreign Earned Income Exclusion, because that's the only thing you're doing in receipt of that income. Self-employed businesses usually are the same thing. You're usually providing a service and getting paid for it, so it's also eligible. Where it gets tricky and often overlooked is if you're selling a product, that's still self-employment income, but the IRS doesn't look at it as all from services, which it technically isn't. The whole idea of selling a product is purchase it for $1 and then you sell it for $2. That's your profit. Now, you're performing a service in there too. You're marketing the product, you're managing the business, maybe you're going out getting clients, selling the product. Of course, you're providing services as the business owner too, but at least a piece of that is from the deployment of capital, and that's what the IRS looks at. So they say a capital-intensive business is one where a substantial amount of the income comes from the deployment of capital. So that's where it gets a little tricky, and where the gray area can be is what is considered as substantial. But in this case, with an e-commerce business, basically the whole business is selling a product, and that's where the profit comes from. So it'd be very hard to argue in that case that capital is not a substantial piece of that business. So in that case, we're stuck with this capital-intensive business rule. And what the IRS says, if you're liking this video, you should really check out my newsletter, where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. What's a reasonable salary from that business? So what's a reasonable compensation for the service part of what you're doing for that business? That we can come up with, and obviously is subjective, but the problem is the IRS puts a 30% limit on that reasonableness calculation. So they say what's reasonable can't be more than 30% of the net income of the business. That's a huge limitation. If you have a business that's making $100,000, you may have thought you were going to get a $100,000 exclusion and you only got 30. So that's $70,000 of taxable income you weren't expecting that now you're going to get hit with tax on. That's a problem and something we want to avoid. So in this scenario though, with this specific person, he was in Spain, purchasing a product from China, selling it in the US. So before we even get to the earned income part though, we have to make sure it's foreign source. And the sourcing, it's very simple with service income because it's just where are you physically providing the services. With inventory though, that rule gets very tricky. And it's different depending on if you're manufacturing the product yourself or if you're purchasing an already manufactured product. In this case, this person was not manufacturing the product themselves. So they were purchasing it from China, selling it in the US. So in that scenario, the sourcing is based on where title passes for that product. So when you're selling through Amazon, title passes in the US. Product comes to the Amazon fulfillment center and somebody purchases it, that's when title passes. So in that case, we actually had US source income, so we don't even get to that earned income part. This person wasn't eligible for the foreign earned income exclusion in the first place. That's a big part of this too, is the sourcing of it. You have to make sure that title is passing outside the US. If you're manufacturing the product yourself outside the US, it's very simple. In that case, it is foreign source, but then you have to deal with the earned income and that 30% rule. So in this specific scenario, what we ended up doing was we set up a US S corporation for the business. So in that case, the S corporation is going to pay a reasonable salary, and it has its own rules for reasonable salary that doesn't have that 30% limitation. So you set up the S corporation, let's say it earns $100,000 from this e-commerce business, pays a reasonable salary of say $60,000 to the owner. That $60,000 is now foreign sourced because it's from the performance of services outside the US, and it's not subject to the 30% limitation because it's a salary. Salary is only from services. So you still got limited. You couldn't take the whole $100,000, and I would recommend paying out the full salary because that's a little bit aggressive. But we were able to salvage a much bigger chunk of the foreign earned income exclusion than just that 30% limitation would have hit us with. Obviously, this calculation and what you would do is different depending on how much money you're making. You know, if this is a $500,000 business, the 30% limit still is going to get you to the $130,000, so you'd be okay in that scenario. But this is a nuance that people don't often look at, so like with anything, get in front of this tax advice. If you think you're going to claim the foreign earned income exclusion, if you're selling a product, definitely reach out to somebody that knows what they're talking about to figure out how this could apply to you and if you need to structure things around it a little bit differently. Feel free to reach out to us at McGowanTax.com. I'd love to set up a call with you personally. Leave a comment in the comment section here if this applies to you. You know, if you have an e-commerce business, let us know. If you have a different type of business and you're not sure if it's capital intensive or not, that's a main question. Leave a comment here. I'd love to respond to you. Thanks for watching.